Hi, everyone. Today we are going to talk about Meta's first quarter 2026 earnings reported yesterday. Big numbers, bigger spending, and one tax benefit that makes the headline net income look prettier than it really is. Let's dig in.
Here's the number you're not supposed to be seeing. Plus 33% year over year on a $56 billion quarter. Most of Wall Street walked into this print expecting Meta to start decelerating. They're a mature ads business, base effects, AI uncertainty, all of it. Instead, growth re-accelerated, and constant currency was 29%, so this isn't a foreign exchange illusion either. Before we get into the numbers, let me set the table real quick. What is Meta today? What does the business actually look like, and why does this quarter matter?
So here's Meta, stripped to the studs. 3.5 billion daily users. That's nearly half the planet that's online. 98% of revenue is ads. Two segments, the family of apps, which is everything you actually use, and Reality Labs, the VR/AR/AI glasses moonshot. About 78,000 employees, but management said on the call they're cutting 10% in May. So, they're growing revenue 33% and shrinking the workforce. That tension is what this whole deck is really about.
This is Meta's revenue mix. $55 billion is advertising across the apps. $885 million is other. That's WhatsApp paid messaging and subscriptions, growing 74% year over year. And Reality Labs is $400 million, less than 1% of the pie. Look how thin that orange slice is. We'll come back to that because the spending picture is the exact opposite shape. The family of apps is the engine. $55.9 billion in revenue this quarter, $27 billion in operating income, a 48% segment margin. And both halves of the ads machine are humming. More ads delivered, plus 12% higher prices on each one. That's the kind of compound growth that's really hard to find at this scale. And then there's Reality Labs. $400 million in revenue, down 2%, $4 billion in operating losses in a single quarter. Quest headset sales are slowing, but here's the interesting bit. The AI glasses category, those Ray-Ban Metas you've maybe seen on someone's face at the airport, daily users tripled year over year. Meta is increasingly betting RL's future on glasses, not headsets.
For the first 18 months of the AI race, Meta was the player without a frontier model of its own. That changed this quarter. They shipped Muse Spark, the first model out of Meta Superintelligence Labs, which Mark stood up just 10 months ago. It's already powering the Meta AI assistant for billions of people, and they're seeing double-digit % increases in sessions per user. So the lab works, the infrastructure works, and that frames everything we're about to look at on the spending side.
All right, now let's get into the numbers themselves. Okay, 6 tiles, 6 headline numbers. Revenue, $56 billion, plus 33%. Net income, $26.8 billion, yes, plus 61%. EPS, $10.44, plus 62. Operating margin, holding at 41%. CapEx, $19.8 billion, up 45% year over year. And daily active people at 3.56 billion. Notice the dips in net income and EPS in Q3 25. That's a one-time tax charge we'll come back to. $26.8 billion in net income in one quarter. To put that in perspective, that's more than Apple makes selling iPhones in most quarters, and Meta's only an ads company. It's the biggest profit they've ever printed, and EPS of $10.44 is also a record.
Okay, important asterisk. $8 billion of that net income came from a tax benefit, not from operating the business. The U.S. Treasury issued a notice in February that reversed part of a big charge Meta took last year. Their effective tax rate this quarter was negative 23%. Yes, negative. Strip the benefit out, EPS was $7.31. Still really good, just not the headline number. The underlying business grew net income about 13%, not 61%.
Now let's look at where that $56 billion actually came from. Look at the shape of this curve. Each Q1 versus the previous Q1 is what tells the real story, and the gap is widening. Q1 24 was $36.5 billion. Q1 25 was $42. Q1 26 is $56.
That's not deceleration. That's a business that's actually accelerating. And the Q2 guide of 58 to 61 billion implies another 25% print is coming. Geography. US and Canada is the biggest chunk by far, 24 billion in Q1, up about 30% year over year. Europe is 13.5 billion, up about 40%. Europe was actually one of the fastest accelerating regions this quarter. Asia Pacific, 11, rest of world, 8. The Q1 dip from Q4 in every region is just holiday seasonality. Black Friday lifts every quarter 4. Year over year is the line to watch. $24 billion from US and Canada alone in one quarter. That's 43% of Meta's revenue from a region that has 6% of the world's population. It's a reminder that for all the global headline numbers, this is still fundamentally a North American advertising business with a massive international user base attached. This is the chart that explains how revenue grew 33% when daily users only grew 4%. Average revenue per person, what each daily user is worth to Meta in a given quarter, went from $12.36 to $15.66. That's a 27% jump per user. So Meta isn't really growing by adding people, the user base is mature. It's growing by extracting more value from the people it already has. 2 ways to grow ad revenue: show more ads or charge more for each one. A year ago, Meta was growing impressions 5% year over year. This quarter, it was 19. Pricing was up 9% then, 12% now. And then there's the WhatsApp business on the bottom. Paid messaging revenue grew 74%. Every lever in the ad business is pulling harder than it was last year. Reality Labs gets one slide because it deserves one slide. $400 million in revenue, $4 billion operating loss. That's a 10-to-1 loss-to-revenue ratio. Q4 last year was the worst quarter ever, $6 billion gone in 3 months. Q1 narrowed the bleed, but make no mistake, this segment loses about $4 billion a quarter every quarter, and management's bet is that glasses eventually become the next computing platform. Okay, money in is the easy part. Money out is where the interesting decisions are. This is the income statement, drawn as a waterfall. Start with revenue at $56 billion. Take $10 billion off for cost of revenue, mostly data center depreciation and cloud spend. R&D is the big one, almost $18 billion in one quarter. That's where the AI talent and silicon spend lives. Marketing, G&A, relatively small. That gets you to operating income of $23 billion, then minus $1 billion for unrealized losses on equity investments, plus that $5 billion tax benefit, and you arrive at the headline $27 billion net income. Look at the gradients here. Marketing and sales, almost flat. G&A, modest. Cost of revenue, tracking revenue at 35%, but R&D, 46%. R&D grew faster than revenue this quarter. That tells you everything about where the money's going, into engineers, GPUs, custom silicon, and AI research. Not sales reps, not ads about Meta itself, not offices. 31% of revenue went into research and development this quarter. That's a record for Meta. Historically, they've run in the high 20s. They're spending almost a third of every dollar that comes in on building the next thing. The next thing is AI, Muse, glasses, recommendation models, ad ranking. The question every investor is asking, does that 31% eventually pay back at higher than 31%? We don't know yet. In 2024, Meta's full-year CapEx was $39 billion. Last year, $72 billion. This year, they're guiding to between $125 and $145 billion, almost doubling again. 2 consecutive doublings of capital expenditure. And mid-quarter, on this very call, management raised the range. They cited higher component prices. Basically, the GPU and memory market is more expensive than they expected 3 months ago. $135 billion. That's the midpoint of this year's CapEx guide. To put that in scale, that's bigger than the GDP of most countries. It's bigger than Meta's entire annual revenue from just 3 years ago. It's the biggest capital bet any pure software company has ever made. Whether it pays back is the single biggest question for Meta over the next 4 quarters. Same quarter last year, Meta returned about $13 billion to shareholders through buybacks. This quarter, 0.
Not a small buyback, not a token, zero. The dividend is still there at about $1.35 billion, but the buyback program, the single biggest mechanism for returning cash to shareholders, paused entirely. That cash is going into the data centers instead. It's a meaningful capital allocation shift, and a shareholder who isn't paying attention can miss it.
Now, let's talk about where they're saying this all goes.
Here's the official guide. Q2 revenue, $58 to $61 billion. Full-year expenses, $162 to $169 billion. Same as before. CapEx, $125 to $145. That's the one they raised. And the tax rate normalizes back to 13 to 16% for the rest of the year. So don't expect another negative tax rate quarter. Operating income should still grow versus last year. That's the commitment.
This is the number nobody talked about. $107 billion in additional contractual commitments signed this quarter alone. That's multi-year cloud deals, infrastructure purchase agreements, GPU contracts. It means Meta has now contractually obligated itself to spend a meaningful chunk of the next several years' cash flow on AI infrastructure. Even if they wanted to slow down, they can't easily. The future is locked in.
For most of the last 2 years, the knock on Meta in the AI race was they don't have a frontier model. They had Llama, but Llama wasn't quite at the frontier. 10 months ago, Mark stood up Meta Superintelligence Labs. This quarter, they shipped Muse Spark, their first model from the new lab. It's now the engine behind Meta AI. Sessions per user are up double digits since launch, and internally, they're already training the next, more advanced generation. The lab works.
Meanwhile, the products are working. AI glasses daily users tripled. Reels time spent on Instagram up 10% in just 1 quarter. Facebook video time up 8% globally, biggest gain in 4 years. 500 million users on each of Facebook and Instagram watching AI-translated videos every week. And business AIs on WhatsApp and Messenger went from 1 million weekly conversations at the start of the year to 10 million now. That's 10x in 4 months. The engagement story is real.
There are 2 ad products that didn't really exist as headline businesses 2 years ago, and both crossed $10 billion in annualized revenue this quarter. Value optimization, that's the suite that prioritizes the highest value conversions for advertisers, is at $20 billion annualized, doubled year over year. Partnership ads, where creators promote brand product, $10 billion run rate, also doubled. And business AIs are still free today. Susan Lee basically said, monetization is coming, just not yet. That's a runway worth tracking. Final piece of the Outlook puzzle. In May, Meta will cut about 10% of its workforce, almost 8,000 people. They called it a leaner operating model. Susan said it's about moving more quickly and offsetting the spending elsewhere. Read between the lines. They're spending $135 billion on AI compute and asking the AI to help do more of the work, so they need fewer humans. Whether you find that inspirational or unsettling is up to you, but the math is explicit.
Okay, so let's put it all together. What's the takeaway?
The bull case writes itself. Revenue accelerating, margins holding, pricing power intact. The lab finally shipped, engagement up everywhere. $32 billion in operating cash flow in a single quarter. The bear case is also real. The headline net income is partly a tax illusion. They paused buybacks, signed $107 billion in commitments, and quietly cut 10% of staff. Reality Labs still loses $4 billion every 90 days, and there are real regulatory trials around youth-related issues that management warned could end in a material loss. Both columns have weight. 6 things to watch over the next year. First, does the CapEx return on invested capital actually show up? $135 billion is the bet, the tell is incremental ad revenue lift. Second, do buybacks come back, or is this a permanent shift? Third, does Meta AI engagement stay sticky after the post-launch bump fades? Fourth, those youth-related trials which management itself flagged as potentially material. And fifth and sixth, both halves of the Reality Labs question. Do glasses become real, and when do the losses stop? None of these will resolve fast, but each one is a signpost. So here's where Meta lands at the end of Q1 2026.
They put 31% of revenue into R&D. They're spending up to $145 billion on infrastructure this year. At one of the biggest software companies in history, they're now also a hardware company. They paused buybacks, they shipped a frontier model, and they're quietly cutting 10% of staff while they do it. The bet is huge. The products are working, but the return on capital is still a thesis, not a proof. The next 4 quarters will tell us if the math works. That's it for today. Don't forget to subscribe.